Hey guys, welcome to the channel and welcome back to another video. We're going to be talking today, guys, about the stock market, ETFs, index funds. Give me a shout out, give me a thumbs up if you can hear me okay, guys, and I would appreciate that. We're going to be talking about really index funds and ETFs and why they make investing so simple to the average everyday Joe, right? Give me a thumbs up, guys, if you can hear me before we jump into this topic today. And I appreciate you guys being here more than you know. I appreciate it. It's not early. It's Saturday morning, guys, about 11 a.m. We do this on Thursdays at 4:30 p.m. Central Time, and we come back and do it again on Saturdays at 11 o'clock in the morning, 11 o'clock a.m. Central Standard Time. And we're also going to actually do a show tomorrow. On Sunday, I want to jump into the 7 baby steps for Dave Ramsey. I really want to break those down and see if they, really ask the question, do they apply to the average person? Can the average person really use them? And what I like and don't like, I agree with some of it, disagree. And so we'll have that conversation tomorrow, guys. Appreciate the thumbs up, guys. Let me know where you're checking in from, by the way. Right? What city, what state, or what country, or even what region of the world or continent that you're on. Let me know in the comments below, guys. We're going to be looking at the comments a lot today. So today we're going to do some learning. We're going to do some talking. We're going to do some back and forth interaction, maybe a little bit of Q&A as well. And so get as active as you want to get in the chat. I am looking at the chat and checking that out as well. Share information, hot tips about ETFs, hot tips about index funds in the chat today, guys. So good morning to you guys. Excuse me. Good morning from Southern California, Tony. Good to have you. East Texas in the house, Steve. John, thumbs up to you. Appreciate it. Let me know you guys can hear me okay. And looks like we got, let's see, Columbus. Is that Columbus, Ohio in the house there from Dominica? Atlanta's here. Good to have you, Hucklebuck, as usual. Good to see you. Thanks for checking in with me today. Knight Rider. Appreciate you, Knight Rider. You're very welcome. Let's see here. Albuquerque, New Mexico in the house. Good, good. Love it. Never been down there. Heard it's very beautiful country down there in Albuquerque. Let me straighten up a little bit. Indiana's in here. Shirley, good to have you. ATL is here as well. Chicago. Is that the west side, south side, north side? Cubs fan, White Sox fan. Dan Ryan, the highway, Columbus, Ohio. Okay, great. Okay. Durham, North Carolina. Good to have you here. Beautiful state of North Carolina. Vermont in the house. Never been to Vermont, upper northeast of America. Got another Daryl checking in from North Carolina. Turkey, the country of Turkey. Good, good. Las Vegas is here as well. Let's see here. Hastings, UK. Good to have you. Let's see here. Bronx, the Boogie Down Bronx is in here as well. We got some ETF suggestions already, right? High yield savings account with ETFs, VTI, VOO, and SMH. Boynton Beach, checking in. Good to have you here, RC. Missouri's in the house. Good state, obviously. Look at that. Kansas City, Missouri, right? Inglewood, up to no good in Inglewood, California. Good to have you. Loretta's in North Carolina. Good to have you, Loretta. East St. Louis is checking in. Not far. Let's see here. So we got a bunch of folks all over, man. Southwest side of Chicago. Good to have you. All right. That's Knight Rider. Merlin is in the house. And then we got Fresno, California checking in. And Richmond, Virginia. Good to have you, Gemini OTS. So, guys, keep the chat active because we want to learn from each other, all right? Listen, I don't have all the answers when it comes to investing. I don't proclaim to know everything or have all the answers. You guys are, smarter than me or just as smart as me, right? Or you're smarter than me, right? But you guys have a lot of answers and you can share information because I really want to keep this thing where we're all learning from each other and not just me barking at you and talking to you, but us talking together, right? So Savannah's in the house. Good to have you. Savannah, Georgia, one conservative chick. Good to have you. So I want to talk about why I'm an index fund guy and why index funds and ETFs, they really, really, really make investing very, very simple for the average person, right? And I believe that all of us, I say all of us, most of us should be investing in index funds and ETFs, right? Now, I'm going to ask you guys, and have some back and forth here. Let me know if in the chat if you invest in index funds or ETFs. Just give me a yes ETFs or yes index fund or yes both in the chat. I'm just curious what we got. And also, don't forget, guys, when you come in here, smash the like button for me, right? Hit that like button. And maybe you know someone who's looking to invest, who wants to invest, or you have a younger sibling, a younger child, an uncle, an aunt, a niece, a nephew who want to get into the stock market investing, but they haven't really got into it. You're going to want to share this video with them because this video is really going to be it's kind of an entry into index funds and ETFs. Now, I know a lot of you actually invest in them, but this is sort of going to be for the people that's the middle investor and the beginner investor. Now, if you are a big time investor and this is all you do is index fund, you've been doing it for 20 years, you know your stuff inside and out, share this video with someone. Share it with someone who's not as seasoned as you, okay? In the description box, guys, you just heard my phone ringing. Check out Mint Mobile. I partner with Mint Mobile. I don't partner with a lot of folks unless I believe in their product. I use Mint Mobile. They're premium wireless service, and they use the world's largest 5G network. So you ain't got to worry about drop calls and all that. Super duper affordable premium wireless services. And that's what this channel is all about, trying to save you money. Make money, save money, invest money. That's what we do here. So Mint Mobile is a good way to do that if you're thinking about switching. I have a link in the description box below. Please click on that if you're tired of paying too much money for your wireless service. Also, we do one-on-ones on this channel as well. I do one-on-one coaching. If you join the channel at the advanced level, you get me for a month for 30 minutes, going back and forth about your own personal situation so we can have that conversation because personal finance is personal. All that stuff is in the description box below. Check that out, guys. And also, drop me a comment, all right? Let me go back here and see if you guys are investing in here in index funds and ETFs or not. Miami's here. Good to have you here. Let's see here. Maria, good to have you. Open up my first individual and Roth account this week. Congratulations, marching bands from home. First individual and Roth account this week. Now I need to fix my income problem. You'll get there. It'll happen for you. Let's see here. Someone says, Lindsay said, automatically invest every month $200 into an ETF. Excellent. Steve is in both. Gemini is learning. This is an excellent opportunity for you to learn right here, Gemini. Brandon, Kevin, they're all in ETFs. Plant Base is an ETF, S&P 500 ETF. So we got some folks here that are investing in two index funds and ETFs. Excellent. So you guys are going to be a good opportunity for you guys to help me throughout this conversation here. Miss Rosie said, I've never invested in ETFs and I'm open-minded about learning more. Yes, you want to learn about ETFs. Absolutely. Exchange traded funds. Dominic asked a question. I have a few brokerage accounts. A couple are with my company retirement and profit sharing by meal. I opened up one for me and I get a Fidelity account because of, should I consolidate? It's up to you, Dominica. Okay, Dominica asked a great question that really is going to come to bear here later on. So I'll answer it right here, guys. If you have different brokerage accounts open in, Fidelity, Vanguard, Charles Schwab, JP Morgan, listen, you can put them all together if you want, or you can keep it separate. If they're for different purposes, nothing wrong with having them separate. If you want to put them all in one big account, that's fine. One big brokerage account, all at Fidelity or all at Charles Schwab, that's okay too. It's really a personal preference thing, guys. There's a lot of ways to split this thing out. You can do it whatever you feel comfortable with. It's like asking, do I need to have my money in all different savings accounts in different banks, or should I have them all in one bank? It's totally a preference thing. It's up to you. It's not going to matter if you have all of your money with Vanguard. It's not going to hurt you if you have all your money at Charles Schwab. Or if you decide, because they're for different things and different people and different situations, separate them. Totally a personal choice, Dominique. I hope that helped you out a little bit. Let's see here. So let's jump into it, guys. I put a poll on the community tab in YouTube just this morning. I put the poll up there. asking how many years have you been investing in the stock market? Just it was a general open question saying how many years have you actually been investing? And lo and behold, guys, I got over 300 plus votes. I don't know if it might be more by now, but I'll tell you exactly what it is. Right now, there's been, let me go to it. I said, how many years have you been investing in the stock market? And I've gotten almost 400 votes on that poll. Now, when I put out a poll on the community tab, I actually read it and take notes and grab and analyze it and grab information from it, because that's what helps me fuel my topics when I make videos and when I do lives. I take those polls and I really go through them and say, hey, maybe this is an area we need to talk about because this is how most people are voting. So when I put that poll out this morning, I knew I was already going to do this video, but I said, let me put the poll out to get a grasp of how everybody is investing. Lo and behold, I wanted to know how long you've been investing in the stock market. And more than 50% of the people said less than 5 years. More than 50% of the people of the 400 that have voted so far said less than 5 years. Only 13%, actually 25%, was over 11 years, over 10 years, right? So that tells me that we have a lot of people that are new to investing, that are scrolling through YouTube, trying to learn, trying to gather new information, trying to figure out what's this mean? What is this all about in terms of, I keep hearing about the stock market. I'm on the internet. I keep hearing about index funds. I keep hearing about, I want to get into it. And some people have just now begun to get into it. A lot of folks, right? I think they said more people are investing in the stock market now in America than ever before. So there's a lot of brand new people who are new to the stock market, guys. And if you're new to the stock market, you have to be very, very careful, because what will happen is they will make the stock market seem so complicated and so complex that it will almost be daunting, and you don't know where to go, where to turn. Man, what stock should I pick? What stock should I not pick? What ETF should I pick? I don't know what to do. All this information becomes overwhelming to a lot of people, right? There's a lot of information out there, and there's a lot of false information out there as well. That's the problem with the information age, right? We get a lot of information, but a lot of the information is bogus, false, biased, skewed, because a lot of times the people are trying to sell you a course about stock market investing or get you to pay for something. Listen, investing in the stock market can be simple. If you're new to investing in the stock market, it can be simple. It does not have to be overly complex, okay? I think I read a poll that said 60% of Americans invest in the stock market. Now, that's retail investors. We are retail investors. When you hear the term retail investors, it means us. We buy our stocks, ETFs, index funds, whatever it may be, individual stocks. We buy them off of the retail market, right? There's two different stock markets, by the way, if you didn't know it. There's a primary stock market and there's a secondary stock market, okay? Primary stock market is when an IPO, a company comes out and they want to turn public, so they offer IPOs, and those are usually offered to the institutional investors. We're retail investors. Institutional investors are the big ones that have millions and billions to play with. The insurance companies, the hedge funds, the pensions, they're the big institutional investors, right? That play with hundreds of millions of dollars. They get the first pick usually of any IPO on the primary market. We come in later as stock market investors, small people, retail investors, and we grab things off of the secondary market, right? So there's two different stock markets. Make sure, if you're new to it, and even if you're not new to it, you should probably understand that, right? We're buying stocks from people that have already bought the stock, the institutional investors that already bought it off the primary market. So anyway, guys, not to go too deep into that, but let's see here. I love it. I just want to make sure I hit some of these chats that are coming in, guys. I appreciate you guys being active in the chat. Super duper helpful. Let's see, not yet, but I'd like to know about it. Stay here because I'm going to give you some stuff in really plain language so that's going to help you understand index funds and ETFs. M1 in Fidelity, Lindsay said, 75% in real estate. Yeah, I'm in real estate also. I'm about 40 or 50% in real estate as well, but we'll talk about that as well. Just transitioned to Mint Mobile. Good job, Jim and I. Let me know how you like it. I love it. Never invested in ETFs, Miss Rosie. This is the place for you. Let's see. I'm going way back. I'm way behind, man. So bear with me, guys. 29 and investing. I should have started when I was 18. You ain't lying, Brandon Love. I agree with you. Let's see here. Is this okay? Somebody asks, is the Charles Schwab starter kit worth it? Totally up to you. If you think, do your research. Okay, I don't know much about the Charles Schwab starter kit for sure, but it says it gives $101 to be invested in a split stock. But I think it's okay. It's probably okay. Charles Schwab is very, very reputable. Okay, very, very reputable. But if you're at Fidelity already and you don't want to switch or move, stay where you're at, right? But if you want to move and you've been reading other things, the thing I tell people about the platform is, what platform are you most comfortable with, and what company are you most comfortable with? If you're comfortable on the Fidelity platform, use Fidelity. If you're comfortable on the Charles Schwab, use Charles Schwab. If you love Vanguard, and if you want, do many of them. So totally up to you, John. Let's see here. Yes, very simple. So we're going to jump into it. Detroit's in the house. Good to have you. Platinum Podcast. Good to have you here. All right. So let me tell you why I like ETFs and index funds. I mean, I'm a big fan of them for several reasons, guys. And you guys can probably attest to this in the chats. But first of all, you have lower fees, guys. Lower fees. Now, I'll talk a little bit more about fees a little later, but fees are kind of important, right? Especially if you're in the stock market for the long term, right? Lower fees means, typically the fees are lower because it's considered more of a passively managed fund. Index funds and ETFs are considered more of a passively managed fund, right? So the fees are lower, which ultimately means for us, the investor, that index funds, because they have a lower fee, it basically costs us less to own the funds when we're talking about index funds and ETFs. Let me say this up front so we're clear, because I know we got some new investors here in the deal. An index fund is a type of mutual fund, okay? Mutual fund, and then you have an index fund, is a type of mutual fund. A mutual fund, in the traditional sense of the word, is what they call, it's more actively managed, okay? And an index fund, the type of mutual fund called an index fund, is more what they call passively managed. So the fees are lower, right? They cost us less to own index funds than it costs us to own a traditional mutual fund, right? So fees can eat away at your returns, and we might talk about that a little bit more later, but so index funds require a little bit less work, right? Index funds are a basket of companies, a basket of stocks, or I like to say a bucket of stocks, right? But it's sort of, index funds are sort of a hands-off approach, because that bucket of stocks is tracking the index, whatever it's designed to track, right? Which means because it's passively managed, it's less money for us to own it. That's really important. The other reason I really like ETFs and index funds, by the way, ETFs are just traded throughout the day. Their price fluctuates throughout the day. They're like index funds. ETFs are a basket of funds as well, basket of stocks as well, or a bucket of stocks. But the ETFs are traded throughout the day. Okay, so name an ETF. It'll start at $294 per share. Throughout the day, it might go to $297 per share. It might go down to $289 per share, right? Index funds, their price doesn't fluctuate throughout the day because they're not traded throughout the day necessarily. They have one price, right? So they're similar. ETFs are a basket of stocks. Index funds are a basket of stocks. ETFs are traded throughout the day, okay? A little bit of difference. But anyway, second thing. When you have index funds and ETFs, and that's why I kind of say index funds and ETFs, because they're very, very similar. Lower risk, right? They're highly diversified. So again, you have a bucket of stocks, right? You don't own just one individual stock. You got a bucket. So your risk is lower. It's spread around, right? Your risk is spread around from the 80 different stocks that are in there. I mean, let's take, for example, Tesla had a bad last week, right? Couple of days into the end of the week because they had a poor earnings report. It didn't look very good. So Tesla stock went down. Well, if you have an overall ETF that's, let's say, tracking the S&P, your ETF is the S&P. The S&P is your ETF, right? So if you have those 500 S&P 500 companies in one big basket, and Tesla is 6% of the weight of the stocks in there, and if Tesla goes bad, like it had a couple of bad days and went down, it's not going to affect your overall portfolio or your overall ETF of the S&P 500 because it's just one of the companies. It's just one of the 500 companies. Yes, it has about 5% of the weight, but you got, 95% of the other weight of the bucket or basket is other companies. So your risk is spread around a little bit, and that's what makes it good, ETFs and index funds, good for new investors. Us newbies. I say us. I've been in it for many years, but some people are new, right? You get your diversification is nice, right? You always hear diversify. When you're in an index fund or ETF, you're highly diversified. And so there's much less volatility, right? Individual stocks may do this like Tesla's doing, right? But your index fund stays pretty steady. Your ETF stays pretty steady. Your risk is lower, which is important for a new investor, right? Because the risk is lower because you're diversified and spread out into 200, 300, 90, 500 different stocks, different companies, right? That's why what's another reason I like index funds, right? And I want to get into some specifics of which index funds you like, and keep sharing, guys. You guys feel free to have that dialogue and conversation in the chat because I'm checking it out too. Let's see, VOO or SPLG. I don't know. Maybe we can look at it. Let's see. He said only been a day. Good. Okay, so personal finance is personal. Hucklebuck, absolutely. Let's see here. And I'm missing a bunch of them, guys, so bear with me here. Minnesota's checking in the house. Let's see. Fire Mike, back with the super chats. Man, I appreciate you more than you know. Thank you so much. Feel free to throw a question in that super chat so I can really hit it for you, Fire Mike. I appreciate that super chat. Thanks so much. Now, we said lower risk because you're highly diversified. We said lower fees, and we're talking about lower than let's say individual stocks, and that's kind of what we're comparing ETFs and index funds to. Now, the third reason I really like ETFs and I really like index funds is because when you look at studies over the years, you see that index funds typically outperform other types of mutual funds. Remember, index funds are a type of mutual fund. Many studies over the years show and prove that just having an index fund will outperform other mutual funds and individual stocks. One of the reasons it'll outperform mutual funds is because, remember, regular mutual funds are actively managed. That means they have a manager or two or three or four who are constantly picking and pulling stocks from the bucket, right? Constantly picking and pulling stocks from the bucket. And you have to pay that manager who actively manages it. They get paid through fees. But the index funds, they have managers too. So, index fund and ETFs have managers too. But that manager is not actively putting in and pulling out every 2 seconds to try to beat the market. That's why it's considered to be more passive. Index funds and ETFs are considered more passive because the goal of an index fund and ETF is not to beat the market. But the goal of an actively managed mutual fund is to try to beat the market. So they're working all the time trying to pull and push and pull, take these out, add that, trying to beat the market. Well, here over in the index fund and ETF space, they're not trying to beat the market. They're just trying to mirror a sector or mirror a specific piece of the market, and they don't have to pick and pull and pull and pick. So, and believe it or not, the ones that don't try to pick and pull and pull and pick, they outperform the ones that are over here trying to pick and pull and pull and pick. So the point is that they tend to outperform. Part of the reason they outperform is because of the lower fees, but part of it is because you just can't pick and pull. If you have professional managers over here that do this stuff every day for a living, how much chance do we have as an individual trying to pick individual stocks? Our chances are low, probably lower than these mutual funds who are actively managed to try to beat the passively managed ETFs and index funds. So you can play the stock game all you want, but the chances are you're not going to outperform an index fund over the course of 5, 10, 15, 20 years. You're not going to do it no matter how well you pick and how well you choose. So because of that, why not just let somebody else do the picking and choosing for you and choose an ETF that tracks a piece of the market that you like or you agree with or you want to track, right? Another reason I really like index funds and ETFs is because this, guys, and this is the really big thing that I think you need to keep in mind. Remember, there's a lot of brand new people who are just now investing in the stock market. Well, index funds and ETFs, they require very little financial knowledge, guys. You don't have to analyze, overanalyze, research, dig in the depths of reading financial statements of individual companies. You don't have to sit and read 10Ks and 10Qs. You don't have to read profit loss statements. You don't have to do all that analyzing, right, of an index fund. Your research for an index fund is not as detailed. It doesn't have to be, right? You look at the benchmark. When I say benchmark, you look at the underlying index or you look at whatever they're tracking. For example, the S&P 500 is an index. NASDAQ is an index. The Dow Jones is an index, right? The Russell 3000 or the Russell 1000, those are indexes. So all you want to know is what are they tracking? What is this bucket of stocks tracking? That's one thing you want to know, right? What stocks or companies, however you want to say it, is this index fund tracking or is this ETF tracking? If it's an S&P index fund or S&P ETF, it's tracking the S&P. If it's a Russell 3000, it's tracking the companies in the Russell 3000. That's what's in the bucket. Simple. That's all. You want to know that first. Now, some people get into tracking errors, right? Sometimes there's tracking errors because there's a deviation between what the fund tracks and how the fund actually tracked it, right? So there's sometimes a slight deviation. And if you want to get real deep into ETFs and index funds, you can do that too. It's called tracking errors, okay? You want to look at expense ratios. Expense ratio is basically what does it cost us to own the index fund? What does it cost us to own the ETF, right? So you want to look at those things as well. So, but other than, maybe you might want to look at past performance, although past performance is not indicative of the future, what's going to happen in the future. You also want to take a look at the market price, right? What is it right now, right? What is VOO right now? What is QQQ, right? What is it? $294? What is it trading at right now, or what is it at right now? You want to know the market price, right? Obviously. But that's okay. You can dig a little deeper, right? The holdings. You can look at the holdings. What are the actual companies that are in this bucket of stocks or bucket of index in the index fund or in the ETF? What companies are there, right? But besides, 6 or 7 different metrics, 6 or 7 different standards, that's it. You don't have to dig into whether or not what their earnings are, what each individual company's earnings are, what the outlook is, what is the projections, you don't have to look into all that. Who is the CEO and what is the upcoming technology that they're really focused on and how are they running their business? If you don't have to do any of that when you invest in ETFs and index funds. Now, if you love doing that, there's nothing wrong with it. If you love having two or three, four, five monitors in front of you, sitting at your desk or looking on your phone, whatever. If you love doing it, there's nothing wrong with it at all. I'm not saying anything's wrong with it. I'm just saying for the average individual investor, if to keep investing simple, index funds, ETFs, simple, right? The point is when you have ETFs and index funds, you analyze much less. There's much less to analyze, right? So it's easier. It doesn't require all of the financial knowledge that you need to have if you're going to really properly invest in individual stocks. Listen, if you invest in individual stocks and you have not looked at a company's profit loss statement, you should. If you invest in individual stocks and you have not looked at the company's 10Q and 10K, in other words, how they did financially, you should. You probably should. If you don't know, if you haven't done any analyzing or researching of a specific company and the company's projections, and you invest in individual stocks, you're investing in individual stocks wrong. Just by watching somebody on TV talk about it, on YouTube talk about it, and then you go buy it, that's not how you invest in individual stocks. That's how you lose money in individual stocks. So my point is that it becomes more complicated when you invest in individual stocks, right? Here's another reason I really love index funds and ETFs, and the reason why I think most of us should be investing in it, even when we're new, right? Or even if we're seasoned, right? And how it makes it so simple. There's a lot of convenience when it comes to investing in ETFs and index funds. You can have all of your favorite type of stocks bundled together, right? You can have your favorite sector, right? Maybe you really enjoy the healthcare sector, right? Maybe you've been a nurse or you've been a doctor, or you've been around healthcare for a long time, and you want to have all of your healthcare stocks. You think healthcare is going to have a big boom or whatever you may think. You can have them all bundled together in a healthcare ETF, right? Or maybe you like small companies. You really love the idea of investing in small companies. Well, there's a lot of small cap ETFs that are out there, small cap, smaller companies, right? That have a smaller cap rate, right? Right? Or have a smaller capitalization. So you can choose to have all of your favorite stuff grouped together in one index fund or in one ETF, right? There's some convenience, right? So, there's a lot of things that I like about investing in ETFs and index funds, right? And I think that they're a perfect match for the passive investor, the passive retail investor, which I'm a passive retail investor. I'm not in the stock market trading every day, right? I'm not doing that, right? Index funds can be, 60 different companies, or it could be 3,000 companies, whatever you choose, right? But the deal with index funds and ETFs, guys, is that you really win in ETFs and index funds over a long sustained period of time, right? Not just quick get in and get out. You can do that if you want. I'm not mad at you if you do. But you really want to be dollar cost averaging into these things over a long stretch, right? And when I say dollar cost average, guys, we just mean you take a set dollar amount and you put it in the market at a set time, always, for a long time. Every 2 weeks, you invest $200 and just do that. Every once a month, you put in $800 and just do that every single month. Not worrying too much about whether the market is up, the market is down. You don't trip on any of that. You just plug it in money, right? Dollar cost averaging into the fund, not trying to guess and time and jump in and jump out, right? When you dollar cost average into an ETF or an index fund over a long period of time, you're sort of obviously spreading your risk around. Like we said, you're mitigating your risk, and you're mitigating yourself against these big losses that happen because you're just steady, right? And you're doing over a long stretch of time. Listen, if I showed you charts, and I probably should bring one up, but if I showed you charts, you see the stock market doing this, going up. Okay, yeah, it has some chinks in the armor here and there, but it for the most part, it's going up, right? So, and the chinks in the armor happen in the short term. You lose money in the short term, chinks in the armor. But for the most part, hold it for a long time, you're going to make some money, typically. Right? What you're saying really by an index fund or an ETF is you're saying that you're telling yourself that I believe that America's businesses or the American business economy is going to be okay over the long stretch. So I'm going to put money in a bunch of stocks because over the long stretch, these bunch of stocks are going to be okay. And they're going to continue to grow over a long stretch. That's what you're saying when you invest in a index fund or a mutual fund, or a ETF. All right. The nature of an index fund is that you are banking on these American businesses doing well over time. Not in the 1 and 2 year span, like I just said, but over the 10-year span, the 5, the 10, the 20, the 30-year span, right? Listen, I don't honestly know enough to pick winners. So I'm not going to come on this YouTube channel and tell you, you need to be investing in this one. This is a winner. That's a winner. This is a winner. I don't know enough to tell you all the winners in the world. I can tell you what I think, in my opinion, what may happen, but I don't know enough to pick the winners. And most of you listening to this, 99.9% of you don't know enough to pick the winners. There's not a lot of Warren Buffetts out there. Trust me. Right? I'm a regular investor. 99% of you all are regular retail investors too. We're all just speculating. We don't know what's going to happen. Right? When we talk about, oh, Tesla went down, but hey, it's going to come back up, I guarantee. We don't know that. You don't know that. We're all speculating. When you invest in index funds and ETFs, you take the speculation kind of off the table. The only thing you're speculating when you invest in index fund and ETFs, you're just speculating that American businesses are going to be okay in the long run. That's the only thing that you're speculating about. You don't have to speculate about individual companies that sit in that basket. No. So I'm nothing special. I haven't done anything special. I don't know enough about individual companies and their 10K. I know how to read a 10K and a 10Q, but I don't study 10Ks and 10Qs. I don't study profit loss statements of individual companies. You know what I did to go from a negative $30,000 to a 7-figure net worth? All I did was I got in the market and I stayed in there for a long time. That's it. I didn't do anything special. I didn't pick a winner. I didn't pick NVIDIA when it was trading at $30 a share and now it's at $500 a share. And all of a sudden I put in 10,000, about 10,000 shares at $30 because I knew it was going to go. No, I didn't do any of that. I just invested in the market, index funds in the market for years and years and years and years and years. That's how I did it. So that's why I can tell you safely that what I'm telling you about how to invest in the stock market in terms of ETFs and index funds works, right? I can't guarantee it's going to work for the next 10, 15, 20 years, but I can tell you exactly how I got to where I am, right? Look, you can know all you want to know about individual companies and you can have all this speculation, right? And be well versed in all of it. And you can still pick the wrong companies. Right? That's just how the stock market works. You can know everything and still pick the wrong companies. That's why an index fund or an ETF it makes investing simple. Right? And investing in ETFs and index funds is very logical, right? The people who pick individual stocks are not coming out ahead of the people who pick broad-based index funds. They aren't. These fund managers I told you that manage these mutual funds and charge a higher fee to manage the mutual fund, they're not coming out higher than, they're not outperforming me over here who don't know a whole lot, right? Who knows enough, right? But don't know, I'm not no expert, but they're not beating me. And I'm just a regular investor. And they're the experts. You see how logically, why would you pay for the experts who aren't beating the retail investors who's picking index funds and ETFs? That's pretty logical, right? A broad index fund with low fees that costs a little bit, You can't beat it, right? You just got to find the one that you want on the platform you want to buy it on. If you want to use a certain platform, whether it's Robinhood or, Interactive Brokers, whatever you decide to use, Vanguard, you find you a platform you like and you invest in index funds and ETFs, do a little bit of research, and you're going to outperform most fund managers, right? So why not make investing simple? Low-cost index funds are best. Broad-based, low-cost index funds over a long stretch of time that you're dollar cost averaging into. Set them out. Now, I asked another question on the poll in the community tab on YouTube about a week ago. How often do you check your investments? And 50 to 60%, maybe 52, 53% of the people said daily or 3 or 4 times a week. You really don't have to do that, folks. If you're dollar cost averaging into a broad-based ETF or a broad-based index fund, you don't have to be checking it every day. What happens is you're going to add to a lot of stress, a lot of anxiety when you check it every day. It's fun sometimes to check it more often. I totally get it because you just want to kind of see where it's at. But, don't get mad. Don't get angry. Don't get anxious or stressed out when you see it dip, right? So just something to think about, guys. So, that's some of the reasons why I really enjoy ETFs and index funds. There's fund managers in the traditional mutual funds that charge more fees, and some fund managers in index funds that charge little fees, right? So keep that in mind. Expense ratio is something but here's the deal. Let me break it down in another way. You got mutual fund managers that charge higher fees. You got index fund managers that charge lower fees. Let's say they get the same results. Let's say they don't underperform and you don't outperform, but index fund, ETFs, mutual funds, same results, same gross results, right? If that happened, you're still going to come out ahead on the index fund. Why? Because of the fees. Okay? So the gross is the same. Just give you an example how logical this is. If the index fund or ETF fund and the mutual fund that's actively managed, if they both do the same gross results, the net results, you're going to still come out ahead because they have higher fees and you're over here paying lower fees. So even if they were the same, you would still outperform them because of the net results. Why not go with an index fund, an ETF, right? And hold for a long time, right? They're over here picking these individual stocks to go in the bucket, and you're over here chilling, dollar cost averaging, right? Even if they got the same results, you come out ahead because of lower fees that you not every index fund, but most index funds, most mutual funds, right? So so over the course of 20 years, this is why fees are important, because not only do you pay lower fees now, but you pay lower fees for a long time, and lower fees for a long time is more money in your pocket as the investor. And fees compound too, right? Dividends compound, fees compound. So over the course of a long time, sure, the fees are a little bit higher for the mutual fund than the index fund, not a big deal, a little bit extra. But you add that up over 15, 20, 30 years, that could be the difference between a $900,000 portfolio and a $700,000 portfolio. $900,000 on the index side, $750,000 on the mutual funds, just because of fees. So over the course of a long time, we're talking, right? So just keep that in mind, guys. When you're looking at ETFs and you're looking at index funds, so compounding happens. It's as simple as that. It doesn't get more complicated than how I'm explaining it to you. Why you want to consider strongly being in index funds and ETFs. It's not complicated. It's not complex, right? But what you hear is a lot of complex language when you're watching Bloomberg TV or you're watching, CNN, Fox. I don't know what you watch, but are you reading Wall Street Journal or something like that? Again, I don't know enough to pick the winners, so I want to just pick the whole bucket. I don't know enough to pick the winners, so I want to just pick just give me the whole basket, right? Called an index fund or an ETF. It's passively managed. That's how it works, and that's why I like them. I don't want to be jumping in and timing the market. I just prefer to spend a long time in the market, not jumping in and out of the market. I forget what the saying was, right? You don't don't time the market, spend time in the market or something like that. That's how you come out ahead. Now, if you just started investing in the stock market last week, 2 months ago, you ain't going to see a whole lot of results, okay? Take your time. It takes time, right? When you have $60,000 in the stock market and the stock market swings and, goes up by 20% one year, you're going to see it. But when you have 600,000 invested in the stock market, the swings get much larger. The swing might have only been $10,000 when you had when you had $60,000. But when you get $600,000 in the market, the swing is going to be a $100,000 swing based on how things happen in the market. But you don't see that until you get to that point, right? Now, I'm also not a day trader. I think I saw something in the chat about day trading. I'm not a day trader guy, right? If you like that, cool, more power to you. Nothing wrong with that, right? But index funds, ETFs, they take the guesswork out. They take some of the speculation out. And they take away a lot of the risk, right? Stock picking ain't easy, guys. It's not easy. Stock picking is guessing if you haven't done your homework. You're just gambling if you haven't done your homework, your research, and know what you're picking in individual stocks, right? Index funds and ETFs, they protect you from having to know all that stuff about each individual company, right? Grab a broad index fund like the S&P, but you do your research, right? There's lots of different types of index funds besides the S&P 500, right? Besides the Russell 3000, there's tons of them. But investing doesn't have to be more complicated than that for you to start winning with your money and taking advantage of the stock market, guys. Right? It doesn't get more complicated than that. Now, there's different types of index funds and different types of ETFs, right? Growth, value, dividend, like VYM, SCHD, right? Dividend index funds or ETFs. But there's even bond ETFs and bond index funds, right? There's all different types of index funds. You've got to do your research to see what you like and don't like. There's small cap, mid cap, large cap, right? Capitalization is outstanding shares times the price of the price. Outstanding shares times the price, right? That's capitalization. Right? So when I say large cap, we're talking the Amazons, the large companies, right? Huge companies, right? Google, right? Tesla, I think, is in the Mag 7. Those are the big ones, right? They have a large cap rate. Apple, Microsoft, large cap rate. Mega, right? You might see mega sometimes, right? So let me go back here, guys. I've been talking a lot, but I'm just trying to help you understand that I know and I realize there's not a lot of new investors. And a lot of times, people that do YouTube videos like this, they don't really slow it down for the new investor. They don't really take the time to explain for the new investor or even for the seasoned investor who may not know or be aware of some of the terminology that's out there or some of the thought processes that are out there. Thought processes, some of the pedagogy. That's a big word, right? Pedagogy that's out there. So somebody said, I'm going to go back a little bit, guys. Somebody said, I love the IT space. IT is killing it right now, right? If you had, let's say, VGT, I'll give you a few of them out here, but if you had VGT, it's a Vanguard technology ETF. If you had VGT was up like 40-something% in 2023. Huge, right? And that's IT, right? So that's something to think about. The S&P is a weighted index fund. So the IT companies that are some of the biggest ones in the world, they take up a large space on the S&P. Yeah, it's 506 or 507 companies in the bucket of the S&P 500, but the big ones make the big large cap at the top 10 make up like 30% because it's weighted, right? It's weighted based on capitalization rate. So the large cap, they take up most of the space in there, and they're the ones that bring in. That's why one of the reasons that the stock market had done so well, or the S&P did so well back in 2023, because the large cap carried it. Small cap, they never carry it. But anyway, that's another story. Yes, I wish I was taught this as a teen too, Mr. Albert. But here's the deal, Mr. Albert. Take this video, the link to this video, share it with a teen. Bless a teen. Bless a 20-year-old. Share it with a 21-year-old. Share it with a 25-year-old. Now, Mr. Albert, you weren't taught this as a teen, but guess what? Now you can pass the information on to other teens. So all is not lost, right? Pass it forward, right? That's why I want you to share this video, because this is the basics that everybody needs to know, right? Let's see. Somebody else said, I can understand dividend ETF as it would be in reinvested new stock purchase compounding. Yep. Buy and hold. That's how I do it. Mommy Trader's in the house. Good to have you, Mommy Trader. Yes, DCA helps create consistency versus timing the market. Yes, absolutely. Just dollar cost average, right? Let's see here. I'm still looking, and I'm a little bit behind, guys, so bear with me. Let me just catch up. Simplified investing. That's what it's all about. I like using Robinhood, somebody said. Robinhood is cool. I'm not a phone app guy, but there's a few apps I use. I'm going to start using one that really keeps writing me and wants me to go ahead and start partnering with them, called Moomoo. And I may go ahead and partner with them down the road. Some of you guys may use Moomoo. I haven't used it yet. I don't partner with anybody on this channel unless I use them and I like them. And I've used some and didn't like them and never brought them up. Speaking of which, Mint Mobile. I do like Mint Mobile. Check them out in the description box if you're thinking about changing to another premium wireless service. It's going to save you some money. Please smash the like button for me, guys. Please smash the like button. The best way you can support this channel and this common sense, plain language about money stuff is to share the video. That's the best way you can support this channel. I've got some free stuff in the description box. Check that out as well. And you can also follow me. I'm on IG, LinkedIn, X or Twitter, Facebook. We have a Facebook group and a Facebook page over there on Facebook where I share a lot of stuff with folks. And Brandon said, I missed 11 years of compound interest. That's okay, Brandon. You can get it back right now. But the sooner, this is why I want you to share it with a young person. The sooner you start doing this, the better. Obviously, you make more money. I'm getting there, Danny. Let's see, Danny. Yes, he scans through them when he gets a break. Sorry, Danny. I'm gonna get through them. Bear with me. Let's see. I rotate 4 ETFs every Monday: SPLG, AIQ, SCHD. I've heard a lot of good stuff about SCHD, guys. If you share what you guys, I'm going to get to them. I'm going to read these comments, I guarantee you, but share a few of these in the comments, guys. I'm a big VOO, VTI guy. I'm a Vanguard person, so most of my stuff is done on Vanguard. Paris, thanks for sharing, Paris. I appreciate it. VGT, huge. SPY, DIA are good ones, but VGT, huge. 10%, 10 to 14% life average returns. Let's see. Investing is a marathon, not a sprint, said Cal. You're definitely right about that. It's definitely a marathon. Time in the market is better than timing the market. That's what I wanted to say. How do you feel about Webull, Robinhood, places like that? I think they're okay. Just read the fine print. If you're going to do Acorns, Robinhood, Webull, Moomoo, be sure to read the fine print. Understand how to get in it, but you need to make sure on some of those, like I used to be on something called Stockpile. You got to make sure you know how to get out of it in case you want to close down your Webull account, in case you want to close down your Robinhood account. What are the terms and conditions, the T's and C's? What are the T's and C's of actually how to get out of it if you want to leave it, right? There may be a penalty involved if you want to close down your Webull account. I don't know, but think about that. Now, I like those bread and butters, right? The Fidelities, the Charles Schwab, the JP Morgans, the Vanguard. I really like those bread and butter brokerage firms and brokerage platforms better than some of the newer ones that have been out in the last 5 or 10 years. Keep it simple investing, but do your homework and research. Always do your homework. Always research. Please do not take it from me what ETF to go buy, what index fund to go buy. Do your own research and understand what you're buying. Understand what that group of stocks or that bucket or basket, what are they? What's being held in them, right? What is the what companies are in there? Know that, guys. Do your research. Don't just take it from me. Don't just take it from Tony Robbins or Robert Kiyosaki or, Dave Ramsey. Don't just take it from those guys or ladies. Susie Orman. You go out and do your own research and understand what you're investing your money into always. But keep it simple. Don't make it complicated. Don't overcomplicate it. Let's see. Somebody says, Ace says, I check about every day to see if there's a dip to buy a bit more. Nothing wrong with that, Ace. Nothing wrong with that at all. Because you want to buy in the dips, that's fine. Let's see here. Yes, time. Somebody said, I think it comes down to being able to detach your emotions from the money. Christopher, that's a great point. Excellent point, Christopher. Thank you for saying that in the comments. The average investor can beat the market, but the caveat is that the average investor can't stomach the dips. Absolutely. The average investor is watching it go this way, hoping it goes right here. That's why I say I don't check mine every day. That's for sure. Okay? Because you can beat the market, but you got to take the emotion out of it, like Christopher said. Right? Because everybody will start panicking. Everybody's feeling good right now. But what happened in 2022 when the market, S&P was down like 18% or something, 18, 19, 20% or whatever. Right? People were like, right? You have to be able to stomach the ups and downs. Very good point. Right? Somebody said I just went all in on Enron. Okay. I think I'm fully covered. International ETFs, Cal said. I'm not a big international guy because I think that a lot of what we invest in America are international companies, right? So I don't double down by saying I want to also do some international ETFs. Not me personally, not in my portfolio, okay? Because I think some of the big ones are worldwide players. Some of the big ones are worldwide players, and that's kind of how I get my exposure internationally. Everybody's a little different about that. Some folks like to have some exposure internationally. I don't necessarily need to have that exposure because I think that these companies, these big companies, they're already all over the world for the most part, with more market share to gain throughout the world as well, right? So Amazon has market share to go gain out in India, right? We can go on, right? But they have more market share to go gain in the rest of the world. And I think they're going that way, a lot of these bigger companies. So as the world becomes more of a global investing space. So great point, Cal. I'm not discounting the foreign companies, just saying that for me personally in my portfolio, I don't dig too much into international. Investing in dividend ETFs is a bonus. Yes. I always suggest, especially for new investors, to really strongly consider reinvesting your dividends as opposed to keeping them and paying them. You can keep them if you want, right? But if you're a 35 or 45-year-old person and you work a job and you pay all your bills, you don't need dividend income to help you pay bills and things like that. Leave it in there. Let it compound too, right? Very important. Let it compound also, okay? Over the course of a lot of years, it will pay off and you'll be like, I'm glad I let that money ride and stay in there, right? I reinvested it, right? So yeah, that's what I try to do, guys. Now, like I said, I'm no expert. I am no financial planner. I'm not a CFP. I'm none of that. I'm just a guy who was able to grow his wealth. I was a broke, grown person, college educated, grown and broke at the age of 30. I had a negative net worth at the age of 30. I had an old 1996 Honda Civic. I had some $25,000 in student loans that I owed, and I had zero assets besides the market value of my car, and I had a little bit in my pension fund from being a teacher, right, for 6 or 7 years. So I had a little bit of money, but I had a negative net worth overall, okay, into the year 2000, right? And from then, everything changed. And that's why 20 plus years later, I can sit before you and tell you, hey, this is what I did. That's all I can really share with you is what I did, what worked for me. And that's what I try to do on this video, this channel. And I try to do it in an authentic way, being transparent, saying, hey, I made a lot of mistakes, but I did a few things right. And here's what I did right. Okay. Elvis said, do you like covered call ETFs? SCHD, I'm not an options guy. Okay. I don't really fool with too many options, right? I don't fool with covered calls and all that good stuff, guys. I know about them, but I just don't do a whole lot of that. So, and I heard a lot of good things about SCHD though. I have one dividend stock, ATT. AT&T is the value. That's a value. AT&T is a value stock, right? Meaning it's tried and true. It's steady, right? It's going to be there in the long run. It's not going to go away. It's not really a growth. We don't expect a lot of growth out of AT&T. So it's considered to be sort of like a value stock, but it pays dividends as well. Let's see here. Somebody said, why is VOO much higher than FXIAX? So VOO is the ETF version. FXIAX is lower, but it's an Admiral share. I think if I'm right, I think I'm right. VXIAX is an Admiral share. And if you invest in Vanguard, they have what they call Admiral shares, right? And there's a minimum investment to get into them, right? So keep that in mind too as you look at Vanguard specifically. Most IT companies carry the biggest in the S&P, absolutely. Let's see. Danny, I got to your comment. He said I read my comment. I had to skip a few of them, guys, because I want to catch up. MGK ETF, Mega Growth, MGK. I do like MGK, all right? I do like MGK. Let me pull up the ticker symbol. I should show you guys a little bit instead of just pulling up or talking about them. But MGK on Vanguard is it MGK? I think that's the mega cap, right? Yeah, mega cap. That's the mega cap. I like it. I like it. Like it a lot, actually. And when they say mega cap, that's the biggest ones, right? The big ones, huge mega cap rates, right? MGK. I'm just reading through these. Hey, thanks for the super chat, Edwin. I appreciate it. Good to have you. Good to be a new member. Smash the like button. And please, by the way, Edwin, make sure you subscribe to the channel. I really appreciate it, guys. All of you that are in here. If you're not a part of the channel, subscribe. I put out videos also, guys. Check those videos out. Shorter videos, 10-minute, 12-minute, 15. Guys, I got a question for you. Do you like the long versions where we spend an hour here talking about investments? We talk about, stock market, or sometimes I talk about, money management. Do you like the long ones, or do you like the short 10 or 12-minute clips or 15-minute videos? I'm curious, guys. I'll be polling you guys and asking you guys that question. Somebody said I hold 2 ETFs and 15 individual stocks. Individual stocks is good. 15, 20, 30, 40 or more in my taxable account. And you have a government TSP. Government TSP is just like index funds. You've got your C fund, your S fund, your G and F, right? These are all in the government's TSP. If you work for the federal government, you have a thrift savings plan, which is basically like a 401k, but it's specifically for federal workers here in America. And in that TSP, those different funds are just like index funds. They're a bucket of stocks. Right. So just want to explain that. Good job, Christopher. Put in as much as you can in that government TSP. Let's see here. Okay, gotcha. Don't underestimate your elders. Ask about mistakes made and how is retirement now. Yes. Listen, if you ask an older person, and I've asked a bunch of them this, if you ask an older person, what's the one thing they regret? And if you're 25 or 20 or 30 or 35 or 40 watching this, hear me closely. The one thing that most of the older people I've talked to and asked that question of that they regret the most is they regret not starting investing sooner and more. Sooner and more. In other words, they regret saying, I'm being 35 years old and only putting 3% in their 401k. If you're 35 years old, try to put in 10, 15%. Stretch yourself if you can. The more you put in at a younger age, the more it would grow. I would be a multi-millionaire right now if I had put in more money at a younger age. That's one of my biggest regrets, right? Being 53 years old, if I could do it again, I'd go back to age 30 and I would just suck it up and put as much, I'd max out my 401k. Or max out my TSP, wherever I was working. Because what happens is, guys, I would have double what I have right now. I'd be a multi but I didn't. So if you're young and if you share this video with a young person, young people, listen to me. Listen to me closely. Overactive tear ducts. Listen to me closely. Please stretch yourself. Put more investment into the market if you can, or put more investments into real estate if you can. Whatever it may be, your choice, or both. Okay. Let's see here. Somebody said I dollar cost average into everything. At what point are we to do some profit taking? When you get ready to chill and kick back. Right? For some of you, it might be 35 years old. Some of you might be 55. Some of you might be 65. At that point, you got money, start pulling some, right? Yeah, everyone is a genius in a bull market. Absolutely check the logic, right? Now, on this channel, I've been telling you I was telling you back in 2022, you need to be in the stock market. You need to be in the stock market. You need to be investing, grabbing things on sale when everything is low, right? When everything is down, you need to be investing, right? Do the opposite of what your natural body tells you to do, right? When everybody's panicking, that's when you want to be investing. Everybody's pulling their money. Oh, everything's going down. Oh, my goodness. Invest, right? So because you're buying low, the whole purpose of this is very logical, guys. Buy low, sell high, or buy low and hold as it goes up. Buy low, sell high, or buy low and hold as it goes up. That's the logic, right? That's how you do everything, right? If you're an investor, right? And if you're a new investor, that's how you invest. And if you buy high, hear me out now. If you buy high, just hold. Don't sell when it goes down. If you sell, you lose. If you hold, ultimately, the stock market has shown us over the last 100 years or less, right? 100 years, it's going to go up over the long haul. It's no guarantee, but that's what it's shown in the past, right? Let's see here. That's what you can learn. Let's see. Buy through the dips. Absolutely, Al Daly said. Very much so. As long as America stays strong, Elvis said, the U.S. market will always rise. Do you think the government will always keep America strong? That's the question of the day, Elvis. That's the question of the day. As long as America, listen, if the stock market goes down for 5 straight years, 10 straight years, we're all in trouble. Everybody's in trouble. America's gone. So if you believe that America is going to keep growing over the next 5, 10, 20, 30, 60 years, 100 years, then you invest in the stock market. But the question that Elvis asked was, do I think that the government will always keep America strong? Always is a strong word. But for the next foreseeable future, 100 years, yes, I think so. Our lifetime, I think so. Right? That's my opinion. Turn the drips on, said Al Daly. Drip, dividend reinvesting, right? Turn that on, he said. Somebody said everything is cyclical. It could be, yeah. America may not be here in 200 or 300 years. Who knows? But neither will you. So if you're going to be here in 200 or 300 years, let me shake your hand, because you're going to be an incredible person. Employer matching is huge. If your employer matches, get the match, but always know what they're actually purchasing with your 401k. Know what it's invested in, right? Let's see. VNQ. What do I think of VNQ? I don't know what VNQ is specifically. I think that's a Vanguard deal. Real estate is what VNQ is. I don't do REITs. I invest in real tangible real estate, so I don't really do REITs and get into real estate ETFs as much. So not a big fan, but do your homework. If it's something you enjoy, go for it. How much of your $1 million is a result of your wife's contribution? Good question. Check the logic. So a small portion of it is, absolutely. She's got a retirement plan as well, but she's only been a part-time worker for 20 plus years, or maybe 20 years, close to 20 years. So a portion of it, but this is together though. So it's not just me doing all this. So that's a good point. Check the logic. Thanks for saying that. 2021, I just changed my mindset, kept my mind in funding account, and here we are. Knight Rider, good. Congratulations. Starting on a new path in the last 3 years. Congratulations to you. Keep it going. How to do the fees work on an ETF? when you figure out an ETF that you're interested in, a VNQ or a VOO, just go look at the expense ratios of it. The lower, the better. The lower, the better. All right. MGK is a rapper. I didn't know MGK was a rapper. I don't listen to rap anymore, guys. Rap nowadays has turned really, really sour. So I'm not big on rap anymore. Let's see. I enjoy all the content, Paris. I'm glad you're here. I'm glad you enjoy it. Shorter to the point videos, Miss Reynolds says, absolutely, you like those better. So I do a combination of both. If you go on my channel, you'll see the 10 minutes, the 12-minute videos, and then you'll also see some of these live. So I try to do both to kind of satisfy both types of folks. But sometimes when it comes to this investing stuff, to explain, sometimes I like to go a little longer. So Brandon said I like the live streams. Thanks, Brandon. Appreciate it. And again, we got them both for both choices, whatever you prefer. Let's see here. Good. Thanks, Plus Ultra. I appreciate that. Oh yeah, VXIAX is Fidelity's version, right? That's Fidelity's version of VOO, and they're both just like VOO. They're tracking the S&P 500. Let's see here. Overnight inventory. I just put $20,000 into Fidelity's S&P. What are your thoughts on this index fund? Listen, if you're tracking the S&P, I love the S&P as an index fund or as an ETF. I love the S&P, right? It's the largest, it's the big 506 or 507. I'm not sure how many is in there right now, guys, but I love the S&P 500. I don't think you can go wrong. Other people love it too, right? You listen to or read, Warren Buffett. He's a big fan of it. Jack Bogle. Listen, S&P 500 is a wonderful place to be. If you only invested your money in the S&P 500, your money would probably be okay for the next 100 years, in my opinion. If you only invested in the S&P 500, you'd probably be just fine for the next foreseeable future for the rest of your life. Okay. So that's fine too, but you can pick and choose others as well. Let's see. Jen said, my company only matches 2% for my 401k and I contribute 15%. Good. She says, should I contribute the 2% for matching and then the other 13% into the S&P? Jen B, excellent question. Excellent question. The answer to that question is, do you like and believe in what your company invests your 15% in? If you don't like it, you don't believe in it, just get the match, your 2%, and then take your other 13% and go do your own investing into something like an S&P 500. Totally your choice, totally up to your decision about what they actually put your money into, right? If you work for a small company and you're not quite sure and they haven't been around long, and then maybe you want to just do the 2% match and pool your money. Now, if you work for the federal government and you know they're going to be there over the next 30, 40 years, hopefully, right? And you feel real comfortable with where they're putting your money, right? Then you might want to say put out the whole 15% with your federal government or with your company that you know is going to be around. But let me say this, guys, about companies. Something to think about. This is another reason I'm not a big fan of individual stocks. Is because if you look at the biggest companies back in the year 2000, the biggest companies in the year 2000, let's say the top 20 companies, they ain't the top 20 companies in 2024. And the top 20 companies in 2024 ain't going to be the top 20 companies in 2044. Okay. So you're playing this into, you're looking at the Mag 7, you're looking at Amazon, and you're looking at Google and Alphabet. You're looking at, Alphabet is Google. You're looking at, what else? NVIDIA. You're looking at all these big Teslas, right? The chances are they ain't going to be around in 20 years. And you're putting all your money in these individual stocks. At some point, you got to know when to pull it out because those companies probably won't be around. Most of them won't be around 20 years later. Just like 20 years ago, those companies ain't the big players today. You got to be thinking about that when you invest in individual stocks. Understand that the top 20 ain't going to be the top 20 in 20 years. So you have to know when to pull them out and when not to pull, when to pull your money out, when not to. You avoid all that when you have a S&P 500 ETF. You avoid all that when you have a total stock market index fund, right? So you got to be thinking about that when you actually are investing in your individual stocks. So Gen B, I hope I answered that question for you. Paris said, at everyone, pay down debts. Yes, guys, if you can, pay down your debts. The more you pay down the debts, the more you have to put into these index funds, and the more you have to invest into these ETFs, right? So, yes, I wish I started earlier. Just started at 50 years old. Nice introvert. You just started at 50, but that's okay. We all make mistakes, right? With money, stop looking back, look forward. What can you do from age 50 to 65? 15 years. That's a long time. Let's get it. Let's go, right? That's what I like to do on this channel. Let's talk about how we can move forward and how we can not make the same mistake, and we can go get it from here. That's the kicker, right? Let's see here. Knight Rider said I like both the long and the short. So I understand sometimes people float in and out on these long ones that we do. Buy those funds. They're on sale. Yeah. QQQ. Heard a lot of good stuff about QQQ. I got to do my research on QQQ. I think is that it? Who is QQQ? You guys tell me. Let's see here. We on Mommy Trader. Check out her channel, guys. Mommy Trader. Her channel is growing on YouTube. Go over to her channel. She digs into the numbers on this investing in a nice way. And she, kind of goes over her own portfolio on her channel. Channel is Mommy Trader here on YouTube. My guy Pocket Watching with JT. I like to give him a shout out sometimes too. He does a great job. Pocket Watching with JT. Want to check his channel out. He really breaks down some of these scammers and so forth, guys. I check his channel out, and I also do the voice for him on his intros, by the way. I'm a voiceover artist too, guys. I do some voiceovers. So if you didn't know, maybe some of you knew, some of you didn't know. Let's see. I'm putting everything in the video at the moment. Andrew, don't put everything in one stock ever. Don't put everything in one stock, Andrew. Spread your risk around. You don't want to do that. Thank you, Knight Rider, for sharing this with your 19-year-old. If you're 19 years old, you need to listen to this, right? I'm not an old fogey. I'm old, but I'm not a fogey, okay? I'm trying to tell you what to do, how to build wealth. This is what we try to do, and we're doing it the simple way. Index funds, ETFs, right? Starting now at 40, Dennis Kelly said, starting at 40. Yes. Man, you got a long way to go. Dennis, you start at 40. Let's start with the basics, right? Have a fully funded emergency fund and get out of your bad debt. Do that first. Make a plan to get out of your bad debt and get your emergency fund, and then you need to invest, right? So just a little heads up there. Hucklebuck, I'm glad you said that. I will invest more. Good. Thanks for saying that, Hucklebuck. Stock trader, stock market will be fine. The rich won't give up their money so easily. Yeah, this is what I think about. Mommy Trader says something that I believe also. It's going to take a lot to make the stock market go away. So one of the reasons I like index funds and ETFs, because I think, in my mind, it ain't going nowhere. You're talking about prying money from people who have had money and built money for hundreds of years. They ain't going to let it go easy. They ain't going to let the stock market go down easy. I don't think the government's going to let the stock market go down that easy. No. So because of that, I think it's going to be around. And guess what happens when you invest in American businesses over a long stretch of time? Always. Okay, let me go back to a video I did a couple days ago. You guys realize that the whole purpose of America is to keep the GDP growing, keep the economy growing, keep the economy growing. That's the whole purpose. America doesn't want 2 or 3 or 4 straight quarters in a year or a year or two of down growth. It just doesn't happen like that. America wants the GDP to keep growing. America wants businesses to keep growing. America wants America to keep growing. So because we have this obsession with growth in America for the American economy, guess what that means for American businesses? Growth. So because our main focus and purpose is growth, that means American businesses will probably grow. And that's why when you look at a chart over the last 100 years of the stock market, what do you see? Growth. You see a line that goes up this way. Yeah, it has a few chinks, but for the most part, it's going what way? That way. And because that way is a representation of the stock market, then that means businesses will keep growing. And if businesses will keep growing, I don't have to pick and choose. I don't have to guess. I don't have to say, oh, I think Tesla's going to do this. I'm not sure about AT&T. I think NVIDIA might do this. Let me go look at their spread, their profit loss statement. Let me go look at their 10Qs. Who is the CEO? Let me read that article. You ain't got to do none of that. None of it. because the stock market is going to go this way. And if it's going to go this way, let me just find me a bucket that I like and let me invest in the bucket. Let me just find me a big old basket that I like and let me invest in the basket. Right? Let me do my research about the basket. Let me do my research about where I want to purchase that basket at. But other than that, I ain't got to do all that extra stuff. That's why ETFs and index funds are simple. They keep investing simple. They make it really, really simple for us new folks, right? Somebody said real estate in the chat. Real estate is cool. I'm a real estate guy too. Real estate typically does what in America? Goes up. That same line that you can track on the GDP going up, there's the same line that you can track on businesses increasing and going up, is the same line you can track on real estate going up. These are appreciating assets, which is where you should be trading in your depreciating asset called cash. You trade in the cash to get something going up in value. Real estate, stocks, whatever it may be. It may be just bonds, right? Which aren't going up very high as much as stocks, but they're still going up a little bit, right? You're trading in the depreciating asset for the appreciating assets that are going up. What are they? Real estate, stocks. And if you want to get stocks, make it simple, buy index funds, buy ETFs, right? The stock market will not fail, or else there'll be a global catastrophe. Yeah, Al said it'd be a global catastrophe if the American stock market fails, right? Let's see here. Exactly. You're making your investments based on your lifetime and maybe your children's. Nobody knows what exactly, Christopher. Good point. Christopher, I like Christopher. He's very down there. He got good common sense there in the comments. All right. I'm 41. How much should I be putting in my 401k? My company matches up to 6%. J Rock, you're 41 years old. Man, you got a long time to go. Congratulations on you, J Rock, for getting it going. Put in the 6% that your company matches. Get that free money. And then you make a decision on where you want to do the rest of your investing. Up to 15, 20%, however much you can stomach investing, you figure that out and you decide if you want to put that in the company or if you want to go out and get your own brokerage account at Charles Schwab or at Vanguard. Right? And I would say about 15% of your money is a great place to be, right? 15 to 20% of your money is a great place if you can do that much, right? Obviously, if you can't, you can't. But if you can, great. The more, the better, right? So let's see. Somebody said the stock market falls all the time. It does. Stocks fall all the time. But the overall trajectory over 5 years, 10 years or longer, that's why buy and hold is a wonderful strategy. Same with real estate. Buy and hold, because over 10 years, it's probably going to go up, right? It will go up, right? So let's see. I put in over 3K a month at 34. You're killing the game right there. 3K a month at 34 years old. Congratulations to you. That's very good. Let's see. SSS says I listen to old school rap. Me too. One day I'm gonna share my album collection with you guys. I got an album collection of old school rap and old 70s R&B and not so R&B. I got a little bit of everything, right? From the Doobie Brothers to Al Green. I got a bunch of stuff over there. That's why you see this speaker. This speaker actually works, guys, by the way. Actually works. I got a 1976 Zenith with an 8-track and a turntable and everything sitting right over there. One day I'll share that with you guys. Let's see. JB, how many accounts is too many? Currently have too many options. You figure out what's best for you. Roth 457, Roth IRA, HSA. It's okay. As long as you can manage them, Jay, you're okay, right? As long as you can manage them. Let's see. Anything S&P, you can't go wrong over the long haul. I agree with that, Andrew. Let's see here. And I appreciate how you guys are helping each other in the chat, right? This is a sort of a learning environment here, guys, where I'm not doing all the talking, but you guys are having some conversation back and forth as well, because I ain't got all the answers. That's why I invest in ETFs. That's why I invest in index funds, because I don't have all the answers, guys. Let's excuse me. Let's see here. S&P 500, invest now. Let's see. JT catching all the scammers. Yeah, JT the pocket watcher. Good guy. Check him out when you can. Mommy Trader's good guy. I listen to a lot of folks, guys, on the internet, on YouTube as well. Invesco is QQQ. JT the pocket watcher. JT the pocket watcher. If you plug that into your search engine, you'll see that. So also fun and budget with Tanisha. All right, check out her too. She's not in here, I don't think, but I watch her too. Fun and budget with Tanisha. I comment on some of her videos. She's comments on mine too. So there's a few folks that I like to shout out, guys, because this is how I am when it comes to money, right? There's enough for all of us. There's plenty for all of us, guys. There's enough to go around. I share information. Information is free. Share it, guys. The more you give, the more it comes back to you. That's a big part of my money philosophy, right? Is it too late to start investing in index funds, stocks, and 401ks at 50 years old? Of course not, QBiz. No. Any money that you accumulate for the next 20 years is yours to keep and go on vacation with, right? The key is it's never too late, right? Over a 20-year span, if you invest 15% of your money over a 20-year span, it's going to turn into hundreds and hundreds of thousands of dollars, right? And you can use it, or if you don't use it, maybe your grandkids will use it. Maybe your nieces or nephews will use it. But it's never too late to invest, no matter what your age is. 50 is not too late. QBiz, watch these videos, right? Send me a shout. Put a question in the comments below. I try to answer the questions, especially on the lives. Put a question. I'll answer it for you. I'll help you, right? You ain't got to pay me nothing. I'll just answer your question for free, right? But I want to get you going and get you started to tell you it's never too late. Never too late. Let's see here. Mommy Trader's channel. I hope she answered that question. It's just at Mommy Trader. Very good. Yeah, check her out. You need to set up 3 buckets, 2-year, 5-year, long-term. Let's see. For 50-year-olds, it's never too late. Thanks for answering that question, guys. I appreciate it. Let's see here. 50 is the new 30. Yeah, it could be. Appreciate it. You got it, Christopher. Let's see here. Is there an annual fee for brokerage accounts? I'm not sure what that question is. I might want to ask that question again. 20% would be amazing. Absolutely amazing. If you're able to put in 20% of your money, man, it's going to grow. But the longer you do it, the better. That's why this type of video is ideal for a young person that's 20, that's 25, that's 30, 35 years old. Guys, share this video with that. Check out Mint Mobile. Let me do a little pause break and check out Mint Mobile, guys, in the description box below. I'm a big fan of them. Been using them for several months now. Excellent service and inexpensive wireless service that's good. Right? That's good. Save money. This is what this channel is about, is helping you guys save money, invest money, make more money, right? Increase your income, right? Increase your value to the marketplace, right? We're all about trying to make sure you can bring in more money and also help you guys manage money. That's a big piece of what I talk about on this channel quite a bit, right? Let's see. Somebody said, where's a good place to put your emergency fund? Hey, you can put your emergency fund into a HYSA high yield savings account if you want, money market account if you want, right? Because money market accounts, typically there's a penalty if you withdraw more than 5 or 10 times throughout the course of a month or whatever it may be, and you're not touching your emergency fund. So you can do a money market fund, you can do a high yield savings account, and you can do your checking account down the street. Doesn't matter. It's just emergency fund. We're not trying to grow emergency fund. Who cares if you got $20,000 in the emergency fund and you make $50 on it, or you make $100 on it, right? You made $150 or $100. Okay, great. That's not where you're investing your money. Your emergency money is just for emergencies. It's not there to grow. It's just a stash to the side. Grow your money, right? Grow your money by investing, right? Somebody's checking in from New Zealand. Mommy Trader said, I miss 90s R&B. I'm more of a 70s R&B, the OJs, right? Staple singers, all that stuff. That's when I was young. 90s is cool too. Don't get me wrong, right? But I'm more of a 70s guy. I like 90s, okay, but back in the 70s was great, man. Okay, so or some of the 80s too. 80s kind of got that pyro-techno stuff going on, which was cool too, right? Let's see. I go with ETF from Vanguard, less capital gains. Absolutely. ETFs also, there's also a taxes component to ETFs that make them a little more, even more, but I'm not a tax guy, so I don't like to go too far into taxes. But let's see here. Let's see, which is best, VGT or XLK? I'm a VGT guy. I'm a Vanguard guy. So that's going to always be my first choice because of their fees. But I don't know. I'd have to do a side by side. Guys, let me share this with you. If you go to websites like, let's do that real quick. XLK versus VGT. Can you guys mind if I share my screen real quick? Let me see here. Present, share. Let's go to, let's do a little comparison side by side. How about that? Somebody brought up two different ones. Let's do a comparison side by side. XLK. Not sure what XLK is, but we'll figure it out. I'll just compare them real quick. Let's see. Here it is right here. Comparison tool. Tell me if you guys can see my screen. Somebody brought up in the chat, they said, what about XLK? And you know what? I don't know what XLK is. So let's see. XLK, what is XLK? Technology sector spider fund. Okay. And then we'll put in VGT, we said. We're just doing by the way, guys, I'm on ETF.com. If you ever want to know a good website to go to compare ETFs or even just to get information about ETFs, go to ETF.com. Let's see here. It's not letting me reset here. It's not letting me compare. Let me do a refresh. All right, let me refresh it. Let's go with XLK or VGT. Oh, what am I doing wrong here? I'm giving it a shot, guys. Bear with me. Let's say my comparison tool is not working. I don't know why it's not working. I tried it. I gave it a shot. Boop. Boop. There it is. All right, now it's working. XLK versus VGT. Somebody asked the question, so I said, let's look it up. Let's compare them, right? So we came over to the comparison tool on ETF.com, and we're looking at the two. Last traded at 201, so XLK is a little cheaper. VGT is $503. That's what it's trading at, right? State Street is where the issuer of XLK, and of course Vanguard is VGT. Expense ratios are about the same, so they cost about the same. Assets under management are about the same, although VGT is a lot higher, right? More than double what the State Street XLK is. And then we're looking at average daily volumes and an index tracker. And so just to compare the two, we'll put them on the graph here. They're very similar, as you can see them, right? Boom, 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 boom. XLK, a little bit higher return than VGT. VGT return at 46%. XLK at about 51%. So they're close. They're very similar over the last year or so. But if we look at them over the last month, and by the way, when you look at this, XLK is going to be on the left-hand side. VGT is going to be on the right-hand side. So over the last 1 month, their returns, okay, XLK has returned a little bit better, but over the last 3 months, they're pretty much identical. Year to date has only been 3 weeks. But over the last 5 years, they're close, 24.82 to 26.93. Over the course of 10 years, they're super close. So these are about the same. Which one do I like better, don't like better? They're close, right? Same. It costs the same in terms of expense ratio. It just costs less to get into XLK. Here's some of the top holdings of them. What do they hold, right? And they're weighted here. So Microsoft is 22% of XLK's holdings is Microsoft. 22% of VGT is Apple, right? Let's see what Microsoft is only 20% of VGT. So if you look at them, guys, these are pretty much the same. The key is you don't have to hold both of them, right? Because there's so much overlap. So you don't have to have both of these. But these are technology ETFs is what they are, guys. These are technology ETFs. They're about the same. So to answer the question, guys, to go back and answer the question, I like them both. I'm a Vanguard guy, so I would probably go with VGT since they're very close in a lot of ways. So just a quick comparison. But for you guys that are new and you want to say, look at a comparison tool, check out ETF.com, right? Check that out, guys. So yeah, I'm way back in the chats, guys. Let's see. KLK is Shares Tech, right? 70s is the best music ever. I agree with that, Mickey. I can listen to any type of music, any music in the 70s, right? Whether it's R&B, soft rap, rock, whatever, soft rock, rap, doesn't matter. Let's see here. Somebody that, okay, well, all right. My HYSA is 4.4%. That's a nice return for you. That's very good. Let's see here. Okay, so we've been on here a long time, guys, hour and a half. I'm going to wrap it up, but I appreciate you guys being here. I really, really do. Again, I have some free stuff down below in the description box. Check that out when you get a chance, guys. 24 Laws of Money is in the description box. Free ebook. My ebook, my gift to you. Doesn't cost any money. Also, of course, in the description box, if you want to join the channel, there'll be a link for you to join the channel. If you join at the advanced level, I do one-on-ones with folks for, it says 15 minutes, but I really go 20, 30 minutes for once a month. And it's, it doesn't cost you hardly anything to have a one-on-one with me. Because everybody's situation is a little bit different. Maybe you have, and maybe it's not investing. Maybe you want to help with it, managing your money. Maybe you want help with your YouTube channel. Maybe you want help with your with understanding how to start a side hustle, side gig, right? Maybe you want to do voiceovers. You want to learn how to get into voiceovers. Maybe you want to learn how to do some affiliate marketing, right? Maybe you want to learn how to grow your grow your business, right? How do you reach out? How do you develop your LinkedIn profile, which I have more than 20-something thousand people connected to me on LinkedIn, right? Maybe you want to, I just have so much information about so many different things, and I share that with you, whether it's your own one-on-one personal situation. I also do long form 2-hour one-on-ones with folks as well, where we actually share screens. We do a Zoom call. We actually go through your personal situation. All of that's in the description box below, along with a link to my schedule. So all that's in the description box, guys. But I used to do that stuff for free. I can't really do it for free anymore, right? So if you want to have a one-on-one with me, it's going to cost you if you become an advanced member of the channel, or if you just want to do a regular 2-hour one-on-one. Those things are going to cost you because it's using up some of my expertise, and I have to go ahead and get paid for that as well. But otherwise, guys, I have hundreds of free YouTube videos. Peep them out. In the last 3 or 4 weeks, month or two, I've been doing more and more videos about investing, about the stock market, index funds, ETFs, because that's what you guys want. That's what you guys, and when I do my polls on the community tab in YouTube, I understand and I listen to what you guys want, and I try to deliver what you want to hear, not just what I want to talk about. Because me, I talk about sports and basketball, and I talk about a bunch of other stuff, right? But I enjoy talking about personal finances and helping people with personal finances, but there's so many different areas of personal finance. But you guys really like to talk about investing and growing your money. So that's why I have these lives in terms of investing. But I want to do today's live to tell you guys that you don't have to make this thing complicated. It doesn't really have to be that complicated. It can be simple. And index funds and ETFs is the simple route to investing that everybody can do with a minimal amount of knowledge. A minimal amount of knowledge. So I just want to say I appreciate you guys for being here. Again, the best way to help this channel is to share this video with a young person, or with a person, period, who wants to actually get better with their money, better with their investing, learn about ETFs, learn about index funds, right? Learn about investing in general in the stock market. So I appreciate you guys. Smash the like, subscribe if you're not a subscriber. And as I always say, I'm going to be back on here tomorrow, guys. I'm going to do a special Sunday video live because I want to dig into these. I had a question about the 7 baby steps. Dave Ramsey's 7 baby steps. Do they really work? I can't do this. I want to have a conversation about that tomorrow, and I'll do a live. Be looking for that. You'll see it in your feed. It'll probably be about 1 o'clock tomorrow, 1 p.m. tomorrow. We'll do a 1 p.m. Central Standard Time here in America. We'll do a live talking about those 7 baby steps because I want to hit them real quick, guys, because I had a couple questions, so I want to talk about them. But hey, guys, until that next live and until the next video comes out, short form video, I appreciate you. Hey, the best person who's going to take care of the old you is the young you. Do me a favor. Take good care of yourself and take care of other people. Until the next video, peace.